The market is so disconnected from reality. If you're making your investments based on where we are today and what the media says, you're missing where we're headed. You can get the trajectory of risk better than you would if you didn't. So anytime there's inflation, the Fed has to raise rates, but also buyers of treasuries are going to demand higher rates of return, because if inflation's going to be 4%, they're going to want at least 5.5% or so on a treasury to counteract for that, on a 10-year treasury. And if you just start thinking as an investor instead of just a real estate investor or a stock market investor, and you want to think like institutional investors do, you're going to say, where do I think the 10-year treasury rate is going to be based upon where you think inflation's going to be, based upon where you think the risk of financial system collapse of the United States being, right? The US Treasury is supposed to be the one place you can go for a risk-free rate of return. So here's where and how they figure it out is, where do we think inflation will be? And let's add about 1.5% to that. That's just a ballpark number. So if you think inflation's going to be 4, let's say you think treasuries are going to be 5.5.
Yeah.
When investors look at, should I park my money in a treasury today, Chris, or should I buy a Class A multifamily property? I want to look at history, and I'm really conservative because I was burned in 08 and 09, right? I'm really conservative, but I ask myself, if I think the treasury has a higher likelihood of going up because I think inflation is going to be higher, then what does that do to cap rates? And what that means is, if I'm paid 5.5, I'm going to make it 5 just for easy math in my head. If I'm paid 5% to park my money in a treasury, historically, to buy a brand new Class A, fine, amenity-rich apartment building, the fund is going to say, I want 230 basis points higher for the risk of buying multifamily over the risk of owning a treasury. So if treasuries are 5, historically speaking, an institutional investor wouldn't want to make any less than 7.3% on their money if they paid all cash today. Well, today, cap rates, if treasuries are 4, cap rates on a brand new building should be about 6.3, but it's so expensive to build them. You can't really make a 6.3 on almost anything new today. And so buyers aren't buying. So you should ask yourself, what's the so what if I'm a passive investor? Where do I think inflation's going to go? And if I think treasuries are going to stay at 4, I should not be buying and investing passively in a brand new apartment building for any less than a 6 to 6.3% cash on cash return if I paid all cash, because I could take less risk and just make 4 or 5 in a treasury, right? So if your syndicator is bringing you a deal on a Class B multifamily that's 20 years old and it's in a secondary market, it's not in a big city, you should want higher than that 6.3% return on your money today. You should want 7, 8 or more. The problem is right now things aren't trading there. So, but if you start thinking about what should I make for the risk, it should be something like that, right? Because if, let's say we have a recession and treasury rates go back down to 2, there's going to be some syndicators that go, man, if I can buy it at a 4.3 cap, I'm going to make so much money on the upside in the future. As long as there's deflation, that could be true. But you have to hedge yourself to say, what if inflation rears its ugly head again after the recession? What if the only way to get us out of a recession is the government to dump helicopter money on us again. And the Fed to cut rates again? It will stimulate the economy. It will stimulate an expansion, but it could create inflation again, where in a few more years, those treasury rates go right back up, your cap rate goes right back up, and then the value of what you bought falls. So I look at this and say, there are as many risks that are inflationary. And if they are, after we get through this, what I believe is a recession, then the cap rates could go back up to where they are today. So don't get too comfortable thinking you got a great deal for today. If it doesn't at least have in your variability analysis, in your, looking at what what could it be worth in 10 years?
Mm-hmm.
You better have an analysis for it could be worth a lot more if values fall, if values go up and cap rates come down and there's less inflation. But it could also be worth less if inflation comes back and values fall. And so you've got to hedge yourself and say, what are the risks of inflation? What are the risks of deflation? How will that impact cap rates? And then my suggestion is in a time right now where there's a lot of uncertainty and volatility, and we don't know the answer to the question yet, is
Mm-hmm.
that we invest for the long term. We only buy deals that cash flow.
That's
So
what I was
maybe
just
you,
going to say. Yep.
yeah, maybe you buy it on a low cap rate. Is as long as it cash flows well with the debt you have on it, and you have the wherewithal to hold it for a decade.
Mm-hmm.
A decade usually smooths out most bumps in the economy. Like a recession lasts 8 to 18 months and averages about 10 months. A recovery period averages about 3 years. And that's the start of the expansion. So you've got to hold it
Right.
5 years just to get back to the start of an expansion period, and probably another 5 years to get back to the next peak when you can sell it for a big profit. And if you don't
Right.
have the wherewithal to park that money and experience some ups and downs in your value because you don't have cash flow or you have variable debt, that's where investors get into a lot of trouble. And that's where we're in a lot of trouble for commercial real estate, and more trouble could be ahead. So you've got to just understand those risks and only put in what you can afford to hold a long time and what, quite frankly, you can afford to lose.
Yeah. I know I've seen several deals come across my desk because we find deals for our clients too, right?
Yeah.
And a lot of them in the apartment space, it's funny that they're trying to still use the old model. They're still saying, you
Yes.
know what, we'll just pay almost nothing. We might even not pay a preferred return. We might just pay nothing for like the
Yeah.
first 5 years. Then finally at year five, we'll sell it, make all this money, and we'll get that 80% or 100% return based on the sale, which to me
Yeah.
is saying, well, that's the riskiest thing of all. You're putting all your chips on one exit strategy working versus is this thing
Yes.
cash flowing right now? Which isn't that
Yeah.
the issue we're having with single family homes too? I mean, people are having a hard time even cash flowing those if they have debt on them.
Absolutely. I think that it comes down to a fundamental question, two fundamental questions, but one is, are you banking on appreciation?
Yeah.
When you are past a recession and you're past a recovery, and it's clear that the economy is now expanding, that is the time that you can speculate and bank on appreciation, because a rising tide lifts all ships. So when the
Mhm.
economy is fully recovered and it's got the new productivity miracle, whatever that is, to make
Mhm.
GDP rise, that's when incomes start going up and people can start investing, and values of everything go up again. It goes in these cycles. But once you've reached a peak, that you can't bank on appreciation because the
Mhm.
whole economy is now contracting and falling. And so being a lifetime investor relies on you understanding, where are we in a total economic cycle? Then the real estate cycle, certain areas of the country and certain asset classes in real estate are doing much, much better than others. So real estate can be very regional and very class specific within your real estate. But if the economy as a whole is contracting, it's the time for you to shift from being aggressively looking for appreciation to be more in what I call preservation mode. And when I put back on my private banking hat, and what I tell my clients is, you want to ask yourself at any point in your life, where are you on that investor timeline? Do you need, most importantly, cash and income? Do you need, most importantly, appreciation? Or do you need, most importantly, asset preservation? And
Mhm.
usually when you're young, you want a lot of income, you got to meet your needs, and then you're willing to invest for growth, and you don't even think about preservation. When you're
Mhm.
old, you better be thinking about preservation of everything you have before you take too much risk to get a little more income or a little more growth and appreciation. But at times when the market is clearly not quite at the bottom, but still has further to fall, I would say that every investor should make asset preservation your number one until there's more certainty about where the economy is. And once you've protected and preserved what you cannot afford to lose, what you need to cash flow, what you need to have that income coming in, then you only invest the extra in I'm going to invest for appreciation, or I'm going to invest for more income, and I'm going to make a wise risk adjusted return decision on what it is that I think is going to give me that growth and income that I can afford to lose or wait a whole lot longer for it to manifest. And so, you started this conversation with people are in paralyzed mode. It's not good to
Mhm.
be paralyzed and not do anything. Um, but I would argue that being in asset preservation mode is a wise strategy. It's just you don't want it just sitting in a checking account making 0.2% when inflation is 2 to 4 or more. You
Yeah.
want to be investing in something where you're saving it and being rewarded for being patient and in preservation mode. Things like a money market account or a CD. Put most of your money there until you find that thing that you can afford to invest in that gives you the cash flow or gives you the growth, and then wait years and years potentially before it manifests itself into a financial reward.
That's true. We've seen a lot more of our clients shift like into our max ROI infinite banking type policies, with like high
Yes.
yield, 6% tax free type of whole life insurance and
Right.
things like that. Because treasuries went up, therefore, so did
Right.
the returns too, right? And people are looking
Yes.
for that safety. Even like Buffett, right? I mean,
Yes.
Buffett's got 347 billion in cash. He's not slowing down well, he slowed down a little bit on the accumulation side this last quarter, but not a lot. And so I'm
Right.
seeing more of that preservation coming into play. And I think that's what people are
Yes.
at this point. They're like, okay, I preserve it, but now what? What do I do? Like, what do you kind of
Right.
foresee like as we're leading into, with even within real estate, like a subclass, like what are you watching right now saying, you know what, this seems to work?
Yeah, I will say it is hard.
Mhm.
Admittedly, I think in my entire investing career, this is the hardest time to make returns in real estate that I've seen in my lifetime. And I'm 50 years old. I was
Yeah.
too little to know as an investor what was happening in the late 90s or early 80s. But
Yeah.
what I will say is that as prices have gone up, because of the lock-in effect of low interest rates, people were able to buy with really cheap debt, which is
Yeah.
why cheap debt, helicopter money and low rates spark asset bubbles.
Mhm.
Everything goes up in value. So you're at a time where you're in a peak of values in almost all asset classes, whether it's single family homes. We were at the peak in
We had an
multifamily.
everything
We've just
bubble.
clearly come down, right?
Yeah.
But you're doing it at the same time as high interest rates. And so it's really difficult to cash flow right now. And most people
Mhm.
that get into investing in real estate, when you're not a ultra high net worth advisor or a fund already, you're
Mhm.
looking for cash flow. You're not looking for the growth. It's the
That's
big
right.
institutions that are like, hey, I want stable 5% of my cash and some growth and upside there too. But because you're looking for cash flow when prices are high, there was tons of demand and very low supply. And I think we're going to have that lock-in effect for several years, Chris. I wish
Mhm.
as a buyer I didn't see this, but the reality is so many people are locked into historically low interest rates, probably that we'll never see again in our lifetime unless we have a real financial crisis again,
Mhm.
that they cannot sell today. They could sell and take their equity, but if they want to even downsize into a smaller home, they're paying significantly more for that home.
That's
And if
right.
they've got to put debt on it, the payments are just too high. So it's hard
Mhm.
to cash flow in real estate today. That's just the reality. If
Yeah.
we take that reality, what it means is it's harder to make good returns than it was in the expansion because there's fewer deals that are going to make financial sense that create that cash flow. So you have to become a really patient investor that says, okay, deals are not okay anymore. I need a two base, hit, or I need a home run or a triple for it to be worth the risk that values could fall a little bit or incomes
Yeah.
could fall a bit in that particular asset class. So again, you're paid to save money right now. But then you got to look at where is there opportunities within real estate
Mhm.
for that are good enough for the return they generate. And one of the things that you've got to do is you have to have enough backbone and enough understanding that when everybody runs away, that's your maximum point of opportunity.
That's
The
right.
maximum point of fear for other investors, whether it's in the market or real estate, means your competition is gone.
If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long term financial security for you and your family. Now they prioritize transparency. They love, building those strong relationships, giving those that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
So right now in real estate, you're seeing in certain areas, I own 2 oceanfront properties in Florida, and Florida has the highest number of listings and people trying to sell, I think since 1979, I read, which was
Wow.
in the midst of the last major inflationary cycle that led to, savings and loan crisis, real estate values plummeting, et cetera. And
Yeah.
so if you are a long-term investor and you have the wherewithal to hold on and wait years for it to turn around, you could go into and look for motivated sellers. We haven't had motivated sellers for a long time. So
Yeah.
if I'm thinking long term, I might go, hey, there's a ton of motivated sellers right now in Florida. I'm bullish on Florida over the long term. Let's go try to create a win-win, get people out of bad deals, get a great price on the basis to where I'm buying it well below its value today, because it could come down in value even more in the short term. But I believe enough in that area that I'm going to wait for the long term. And as long as you can buy it at a price and an interest rate that cash flows, you can afford to hold on to that property so that you see the materialization of those returns into the future. On a
Right.
short-term basis, it's a dangerous thing to do. It's just like in the stock market, we say, don't be careful not to catch a falling knife. Like if values are falling and there's low supply and rates stay high longer, and people are locked in and they're afraid to move in Florida because of the insurance costs and the taxes and all of those things going way up, values could fall further. So it
Yeah.
can't be a short-term play, but I'm always looking for where can I find growth and where can I find cash flow where there's motivated sellers, where I can make a whole bunch of offers and I'm likely to get one accepted. There's certain pockets of the country and certain asset classes like the short-term rentals that people way overbought. They were oversaturated. And now that travel's slowing down, a lot of these Airbnbs, they're losing money every month. They can't afford to make their mortgage payments. So
So a lot of
if
them are
I can
turning
go
to
help
mid or long
them.
term rentals, right?
Exactly. And
Yeah.
that's where you have to buy it low enough. The short-term rentals, and I have several. I have 5, I think now around the country that are what I call luxury short-term rentals. And then I have some short and mid-term rentals in my apartment complexes as well. But when you're talking about purely vacation rentals, they are some of the most motivated sellers in Tennessee, in Florida, right? And so if they were selling based on prices, based on the income they generated, just like in commercial real estate.
Yeah.
Now they've got to sell at a price per door being compared to a long-term rental. So their values have come way down. That could be an opportunity for you to go in, put a long-term rental or a midterm rental if it's near a hospital, especially, and make enough cash flow on that thing that eventually, when we get to the next expansion period, whenever that is, you can then shift it back to a short-term rental or the values will go way back up again. So that's where I kind of see the biggest opportunity is those areas where there's a lot of oversaturation. Buy them cheap, turn them into rentals, hold them for the long term.
Yeah. Basically, run in when everybody wants to sell and then sell when nobody else wants to run, right? Which, like you said, this might be a good time to capitalize on gains in a lot of different areas and
Yeah.
redirect that money elsewhere.
Yeah. And commercial. I mean, apartments are in a lot of pain. So to the
Yeah.
point before, I'm still looking at deals. In fact, I'm analyzing 2 deals today that are off market, that are apartment buildings, but I'm going to want to pay a whole lot less for that property than the seller's going to want to sell.
Yep.
So I may not be able to take down, the deal at a number that makes sense for me. And then I've got to, potentially pass on it. But when everybody's afraid and the sellers that are selling because they have to, they've got debt that's renewing or they wouldn't be selling, they would be holding on to them. That could be huge opportunity for you, but it's also huge risk. And so you've got to know your risk tolerance and you've got to know how much risk am I willing to take with my money and my investors' money? And the returns better be real, real good if it's a bigger dollar property, because the bigger the dollars, the bigger the risks that things in the economy shift in a way that isn't on your side. And you've got to
Right.
have the wherewithal to live through some bumpy times until, you can cash flow and until you can, hopefully sell it at a peak again in the future at some point.
Absolutely. Yeah. We literally just had a client who's got millions just sitting in cash right now, wondering what to do with it. Sent us a deal from Florida, and
Yeah.
uh, and of course he's like, "What do you think?" And we had different, questions, clarifying questions about some of the renovations value add that they were talking about. But then I sent it to one of our friends, a mutual friend of ours that's in St. Pete, in Florida. He looked
Uh,
at it and he said, "This is 20% overvalued. I would pay 20% less for them what they're asking right now." And by the
yeah.
time I send him that information, he's like, "All right, I'm not doing the deal. I'm out." And that's the thing. Like, you have
Yeah.
to really be picky right now.
Absolutely. Yeah. This is the time. I think there's more pain ahead. There's
Yeah.
so many things and I think you have to realize when you realize we are in an everything bubble and
Mhm.
almost all assets are overvalued right now to some extent, other than commercial real estate. A lot of it really is undervalued in terms of, the other question I ask is how much would it cost me to build it? If I can
Yeah.
buy it below replacement costs and it cash flows, I might have
Mhm.
to put a whole lot more money down, right? I might
Yeah.
not get the 80% loan that we're so used to. You might get a 50% leverage deal, but if you can get in 50% leverage cash flow and you're buying it for below replacement value, that could be, a good deal. But you've got to ask yourself, has the bubble yet popped in this
Mhm.
market, in this asset class? And what things could make the bubble pop? If we get in an escalated trade war with China, could it make the bubble in this area pop? Could it make the jobs in this area that are supporting the renters in this area become non-existent?
Right.
And so I think you've got to look at like so many more things today with all these wars and rumors of wars and
Mhm.
threats to supply chains. Like, is the investment you're looking for in an area that's really resilient? And this is my
Yeah.
other thing. Like, I want to invest for recession resilience. There's nothing that's recession proof. I want to
Yeah.
invest for inflation resilience. There's nothing that's inflation proof, right? We say in part apartments are inflation resistant. Well, they are until interest rates go up that make
Yeah.
your values on paper fall, right? And so
Same with
we're learning that
self-storage.
lesson. Self-storage, pretty much everything. So I want to invest for resilience. And the key to that, no matter what the asset class is, what are the incomes and what's driving the incomes in the market in which you're investing? And so when
Yeah.
it comes to real estate, I don't want to be investing in secondary and tertiary markets. I don't want to be investing in military cities. I'm going to pick on
Mhm.
two cities, Killeen, Texas, and Oklahoma City, Oklahoma, right?
Mhm.
Killeen, Texas, you saw tons of deals and they're still trying to sell them at ridiculous prices. The risk is if we get into wars, all your tenant base moves and then they break their leases and you can't go after them for rent because they're serving our
Right.
country, right?
Yeah.
So that's kind of a risky area. Oklahoma City was so oversaturated, their average vacancy rate for over a decade was 14% vacant,
Oh.
where the rest of the country was 8 to 9%. So if you're in an area that has high vacancy rate, there's not enough jobs to support being full, then you shouldn't be going and buying in that market just because you can buy them cheaper. And on paper, it looks like it's going to make you great returns, but there's not the fundamental drivers of people moving in. So
Mhm.
you've got to look at where are the markets where people are moving in. They're pro-growth. Cities that are conservative for taxes, they're conservative. They're going to give businesses like Texas, Dallas, Texas area, they're paying
Red states.
companies to come. You come build your
Yeah.
facility here. We'll give you tax abatement because they're pro-growth. And so you've got to be in these, more conservative cities that are pro-growth, that people are moving to, that have great job diversity, many different types of employers. Those are the areas that if you buy almost anything there, you're going to do well over the long term because there's going to be continued growth, continued incomes that support, your rental income and your cash flow. Just don't chase yield in secondary and tertiary markets or cities that are dying. Go into really great areas, and you should be able to be resilient through good times and bad when you're in those markets that are going to be really resilient and pro-growth, even if the rest of the country isn't growing.
Right. Great, great points.
Yeah,
Man, we can go on forever. We really could.
it's
We're actually breaking
fun. Yeah.
we this is why we had to break this up into two episodes just for this reason, because this is incredible, incredible information here. Now, a few questions I want to ask you before I let you go. First and foremost, people want to follow you. What's the best way to do so?
Great. You can find me on my website at annakelleyinvesting.com if you're interested in real estate or wealth coaching and consulting. And you can follow me on social media at Anna Kelley, REI Mom.
Yeah, tell us more about being an REI mom.
Well, it was one of those things I just came up with. I'm like, what are the two things that I spend the most time doing? I'm a real estate investor and I'm a mom. So I was the REI mom. And this is funny, but on social media, I was speaking at a lot of events and I
Mhm.
started to have some kind of creepy people try to follow me and friend me on social. And I
Sorry
had
about that.
pictures of my young
I'm just
kids,
kidding.
pictures of my young kids and where they went to school and different kind of things. And unfortunately, when I was in college, I was stalked. I had a stalker. And so I
Mm.
was just really nervous about, as I was talking about wealth and how I grew wealth and trying to encourage other people, like I didn't want people knowing my last name. So I just was like, Anna REI Mom. That was my name on Facebook.
Huh.
And eventually it became a brand. People were like, I love your brand. I love the REI Mom. And I was like, it was kind of unintentional, but I'll take it. Then I created a company called REI Mom, where I really especially pour into women and
Mhm.
young women, and really have a heart for women becoming financially independent, being able to take care of themselves and make wise investment decisions. I came from poverty. My mom was a battered woman, and I didn't know anything about money and how to get out of that cycle. And so it became kind of a passion project and a company really pouring into women. Now it's grown so much bigger than that, but that's where
Yeah,
REI Mom came.
I love it. We'll definitely put the contact info so people can follow you, look you up, and all that kind of stuff too.
Thank you
So,
so much.
well, final question. As you know, it's the Money Ripples podcast, right? We talk about the ripple effect you create in people's lives. So,
Yeah.
Anna, what do you feel is like your ripple effect on this planet?
I think first and foremost, I believe in God. My faith is really important to me. And I believe that we're here to love God and love other people and to do that however we can with wherever we're planted, with our skills, our resources, our talents, our wisdom that we gain over time. And so, first and foremost, I'm a child of God that loves other people, and I want them to know and experience the love of God and how valuable they are to Him. And then number two, I want to teach them how to wisely use money as a tool, not as the end all be all, not as what we're really pursuing. I mean, yes, we talk a lot about wealth, but you can be
Mhm.
very wealthy in life without having a lot of money. But
That's
God
right.
talks to us a lot about stewarding our money well, and we can be a blessing to so many more people and to our families when we do learn how to steward wealth well. So I would say, one of my mottos that I end a lot of my presentations with is love God, love people, use money, and never give up. And so if I can encourage people to be curious about that and understand that there's a God that loves them and that we're not here just to become wealthy and enjoy everything ourselves and hoard it, but we're to love other people, to want to bless other people, and then love people and use money, not the other way around,
Hmm.
and then just never give up because life is hard. Finances are hard. We win and lose in many areas of life, but if we have hope and don't give up, if I can leave that legacy in my family and my students and my investors, just to encourage people, to focus on those four things, then I think it'll be a ripple well worth leaving.
Oh, I love it. You aligned perfectly with what I know our listeners listen to on this show all the time, especially where we actually talk a lot about stewardship as being
Yes.
really the only abundant mindset when it comes to money, where spenders and savers have a scarcity mindset. Stewards have an
Yes.
abundance mindset because they're looking to use it to magnify, edify, and grow
Yes.
and improve, not just enrich your life, but the lives of those around you. So well
Love
said.
it.
Well,
Thank
thank you
you.
again so much today, Anna. Like this has been a fantastic conversation. I know that we've got to have you back on again, as long as we can make sure that that happens, right? So,
I
um,
would love that. Thank you so much for having me. It's been a pleasure.
yeah, same here, Anna. So, everybody, you heard it. Like, it's all about stewardship, right? It is about that. Ultimately, is what we're here to do. And of course, what is it? We're in an everything bubble. Do we sit around and do nothing? No, not necessarily. But it does mean that we do need to be more cautious, more careful. We cannot just rest and think that we just throw money in something and we're going to make money. It requires us to be brain on investors at the same time as being hands off investors. So, guys,
Mm.
make it a wonderful and prosperous week. And we'll see you later.